look if you have questions about how any of the quiz questions were worked. Okay, so this is off of Canvas. Okay, and if you brought your computer, you could probably see it there. If not, and you didn't print it, you can just follow along here. And then if you want to sort of compare this and watch this video again later, you can do that as well. Okay, so let's just go ahead and let's take a look at this first one. And we have this bakery, and they're telling us what their revenues are. Revenues are reported where? Income statement or balance sheet? Okay, that's going to be reported on my income statement, right? And my expenses are also going to report on my income statement as I derive my net income, right? So they give me revenues, expenses. They tell me the dividends that are paid. Now, dividends are going to be reported on the statement of retained earnings, aren't they? Okay, as I pay those out of my retained earnings. And then this question had a little bit of a wrinkle in there, and that they sit there and they ask you, what is the amount of stockholders' equity? So you're sitting there saying, well, they give me all the tools to answer something about retained earnings, and then the question makes a turn on me here and says, well, tell me about stockholders' equity. So you'd have to sit there and say, well, look, I got to answer this question, and I know that my stockholders' equity consists of what? What are the two accounts? Two accounts of stockholders' equity? Okay, common stock, okay, and what? Retained earnings. So it must be that I'm going to have to sit here and analyze retained earnings to be able to answer this question, because they don't tell me anything about common stock, do they? So I can't sit there and figure in any factors for common stock on this. So the way I would set this up, I would just go ahead and set it up beginning balance. What are the adds to the accounts? What are the subtracts from the account? And they're asking me here, the unknown is this ending balance, isn't it? Okay, so if they just started operations, what's the beginning balance? Beginning balance and retained earnings is 0. I haven't had a chance to retain any earnings, right? I just started this company. Good. I know that the add is going to be net income, isn't it? Okay, so what I would do is I would go off to the side and calculate my net income. And so my net income is going to be my revenues, right? How much were my revenues? 60,000, good. Minus my expenses. How much are my expenses? 35,000, good. That difference is going to be what? 25,000? So my net income ends up being $25,000, doesn't it? Well, that's an add to my retained earnings, right? I'm going to retain my earnings, so I'm going to add that in, 25,000. With me so far? Okay. Then what? When I pay the dividend, I pay that dividend what? Out of my stockholders' equity, or excuse me, my retained earnings, but they're making me analyze stockholders' equity here, the way they asked me this question. But it's paid out of my retained earnings, right? So that's a subtract of $20,000. So the ending balance in my retained earnings after I've paid out that dividend must be this $5,000, right? Okay, now they're calling this a $5,000 credit here, and all that is saying to me is what? Well, there was a 0 beginning balance. The difference is revenue a debit or a credit? Is revenue a debit or a credit? Revenue is a credit. Okay, when I have revenue, I do what? I debit cash, say, for, what is it, 60,000? And I credit what? Revenue. If I have revenue for 60,000, right? Right? Okay, if I have expenses, what do? I debit my expense. What was it? 35,000 here? And I credit my cash. Just trying to write that in somewhere where it doesn't make a mess, but I guess it does make a mess. Credit cash for 25,000, right? So revenue is a credit, expense is a debit, isn't it? Okay. Okay. How much? 35,000. Credit my cash, 35,000. Thank you. And so if revenue is a credit and expense is a debit, then my net income must be 25,000. That means my credits were more than my debits, weren't they? Okay, and so what happens, at least, I mean, debits equal credits, but at least the ones that affect the income statement, the credits were more, and so that's a credit. Dividend is a debit, isn't it? When I debit the dividend, and so the net impact of this is a $5,000 credit, isn't it? Okay. All right, good. September 2nd, promise ring, reported stockholders' equity of $156,000 during the month. They generated revenues, and they start to read through this, but let's just look. Again, we're asking you stockholders' equity. Stockholders' equity is made up of what two accounts? Retained earnings and common stock. They're not telling me anything about common stock here, so I'm going to have to analyze retained earnings even though we're asking about stockholders' equity. And so what happens? I would do the same thing, beginning balance, add, subtract, ending balance. What's the beginning balance here? They had 156,000 at September 1st. Since they're asking me the end of the month, September 30th, the beginning balance is 156,000, even though I'm just analyzing retained earnings here, right? Okay. Then what happens? Then I have to add. What's my add to my retained earnings, everybody? What do we call that? Everybody? The add to my retained earnings is net income, so I go ahead and I take the revenue. Revenue is what? 38,000 minus my expenses. Expenses are 21,000. That means I have a net income sitting here of what? 17,000. Thank you. Okay, so I go ahead and I add in my net income, 17,000. The subtract would be dividends. Do they have any dividends? They paid dividends of 2,000, didn't they? So I subtract out the dividend. That gives me an ending balance here of the 171. Is that the ending balance? Okay. What about the purchase of the equipment? The equipment is no impact on my retained earnings, right? Okay, if I purchase that for cash, it's going to be, and remember, if you looked at that connect exercise, I was showing you, hey, there's sometimes where we make a transaction affects entirely the balance sheet. One asset, cash, goes down. Another asset, cash, goes up. Has no impact on retained earnings at all, right? If I had borrowed money for this equipment, my asset would have gone up equipment, but my liability also would have gone up. My accounting equation would have stayed in balance, right? There is no stockholders' equity / in this example, retained earnings impact for the purchase of equipment. Okay? All right, good. Let's go ahead and let's take a look at this next one. And I received cash of $700 from a customer. When I receive cash from a customer, well, let's set this up. I provide the service, don't I? And if I provide the service, should I recognize the revenue? If I provide the service, I can recognize the revenue, so I'm going to credit revenue for $700, right? Okay. Now what happens? The person doesn't pay me right away. Should I not take the revenue if they don't pay me yet? They tell me, hey, I'll pay you later. Should I not take the revenue? It's still revenue because I've provided the service, haven't I? Okay, so I can't debit cash, but I debit what? Accounts receivable for $700. I'm going to receive that money later, right? Accounts receivable is an asset, isn't it? Okay, so then what happens? Then the person goes ahead and pays me, and they pay me $700. Cash received. Oh, great. I showed you the wrong transaction, though. So never mind everything I just said. I misread that. It's what? Received a cash advance from a customer. If I receive cash advance, someone is providing me the cash what? In advance of providing the service, right? Okay, so if that's the case, what happens? Obviously, I'm going to debit cash because I'm receiving cash for $700. I have to credit something, don't I? I credit a liability called unearned revenue because what? If I don't pay the person, am I going to have to pay them back? Right? So I'm going to have unearned revenue of $700 here, and if I have to pay the person back, I will, right? Okay. So what? Only assets increased $700 here. My stockholders' equity didn't increase because I haven't provided any service yet. There's no revenue there. My liabilities didn't decrease. My liability did what? It increased, didn't it? Okay. Assets and stockholders' equity increased by 7. Stockholders' equity wasn't affected at all, was it? Right? Okay. What happens when the person, now I provide the service? What should I do? I go ahead and I provide the person the service now. Can I recognize that revenue? So if I provide the service, I go ahead and I credit revenue for $700. I have to debit something, don't I? What do I debit? The unearned revenue. Good, because I've now provided that service, right? That says unearned. I'm just going to debit the unearned. I'm just call it unearned rather than call out the revenue. I debit the unearned revenue. Okay. Okay, good. Now come over and take a look at this next one. And now we've got this Sebastian Bella, whatever, has performed services for $2,000 for CPA services, okay, for a client. But at the end of the year, they hadn't billed the client yet, and now they're going to go ahead and bill them. Okay, so we're going to have to make an adjustment to the financial statements. That's what we mean by an adjusting entry, meaning we're kind of catching up and cleaning up for things that had happened during the month or during the year, and now we're catching them up at the end of the year. We're adjusting the accounts. So if I provided the service, can I recognize the revenue? If I provide the service, I can recognize the revenue. So I know I've got to credit revenue, what, $2,000 in this example? I have to debit something, don't I? The debit's got to go to accounts receivable because I haven't received the cash yet, but I will soon, right? Hopefully this person will pay me, right? And I'll receive that cash soon, $2,000. I set that up as a receivable. So important takeaway. Notice that the cash does not drive the recognition of revenue. It's what? The performance of the service, isn't it? Just like up here, we got the cash in advance. We got the $700 in advance, but that didn't drive the recognition of the revenue. It was when we had finally got around and provided the service that we took the revenue. So cash does not drive what we do. It's the activity. Are we providing the service or not, right? Okay. Okay, good. Now, what happened? So we debited the accounts receivable, we credited service revenue. There's that entry right there. And then it turns out that a little bit later, she goes ahead and gets paid. The person pays her the cash, right? Let's say they pay her the whole, let's say they pay her $1,500. We don't have to make it the whole amount. Let's say they pay her $1,500. What's the amount of cash then? $1,500. I debit cash $1,500. What do you want me to credit? I'm going to credit the accounts receivable now because what? I've received that money. Okay, and if you watch that video on that connect problem, that's where I was going nuts because the balance sheet that they provided us never showed accounts receivable. So we set up the accounts receivable. When I tried to go over the balance sheet and find it, it wasn't there. And the reason it wasn't there is because the book contemplated that they were going to have you in that same problem do what? Receive the cash. That would have made the accounts receivable zero. That's why I couldn't find it there because of the way the book set it up. It's not a real general ledger system. In a real general ledger system, they would put the receivable there. It would hang there until what? Until we received the money. Then it would disappear off. Okay? Okay, good. Come over and let's take a look at this one, Froggy Company. Okay? And Froggy Company has their first year of operations with revenue, expenses. So what should happen to the retained earnings? You can usually tell if I made up the problem if the name is Froggy or Buster's, and the question is real easy. Okay, so if I have my revenue, how much? 200,000. I have my expenses, how much? 70,000. My net income is 130,000. I don't know if I can give you an easy question like that on the midterm. Okay. Question? Yes, sir. hmm I'm just saying that they had 2,000 of account receivable and they collected 1,500, right? Yeah, number 4, they had a receivable of 2,000, and I'm just, kind of making it up as I go along here. They collected 1,500 of it, right? How much is still owed to them? Huh? 500, right? Okay. And what would happen? That's what accounting's all about. I would sit there and the reason we have this whole stupid process is I would sit here and I would have this accounts receivable up here, and I'm just showing you the way the ledger accounts look. And I would have originally done what? Debited it for 2,000. What do we call that when I go from the general journal to the ledger? Good. I'm going to post it. Very good. I post it. That gives me a balance here of what? 2,000? Right? That says 2,000, a balance. And then I went ahead and I credited it 1,500 when they pay me 1,500, right? And so now the balance is how much? The balance is how much now? 500. Okay? So what happens? If somebody calls and says, "Hey, Sebastian Bell, how much do I owe you now?" She can press a button and say, 500, please, right? It's sitting right there at any point in time, right? Or she can resend another bill with the new balance if somebody doesn't pay her or something, right? Okay? Okay, good. Come over and let's take a look at this next one. Froggy Company collects $120,000 on June 30th, 2015 for monthly services to be rendered between July 1st and June 30th, 2016. How many months is that? That's 12 months, isn't it? It's a fiscal year period, but it's 12 months. Okay? And they give him how much? 120,000. If I'm going to be providing services over that 12-month period, that means that's $10,000 a month, isn't it? Okay, even I can handle that one in my head. $10,000 a month. Okay, good. On July 1st, 2015, which of the following best describes the impact for this transaction on Froggy's financial statements? Well, just let's think about this first. If they've provided, let's go through the whole process. When they give this 120,000 on June 30th, what journal entry should we make when we receive this 120,000? When we receive cash, what journal entry should we make? Debit cash, 120,000, good. And credit what did I hear? Unearned revenue, because at June 30th, I haven't provided any service yet, right? Credit unearned revenue for 120,000, right? Because he hasn't earned any of that revenue yet. That's at June 30th, 6:30. Okay, good. Now, what happens when he provides service now in July? On July 1st, which of the following best describes the impact? Have we had a situation where if we got the money on June 30th, by July 1st, assets and liabilities have increased? Cash increased? Unearned revenue increased? Right? Assets increased, unearned revenue increased? Okay, by this 120,000. Now, what if, I think the next question actually is what does this. I say, using the same facts, what impact will providing the service have on Froggy's financial statements? So let's say now at July 31st, I've provided 1 month of service, haven't I? So I've earned that 1 month of service, so I'm going to do what? Can I credit revenue for 10,000 now? Because I've provided that service for 1 month. And can I debit what? Unearned? Unearned revenue of 10,000? Right? right? What's the balance in the unearned revenue account? The balance in the unearned revenue, when I first got the money, it was a credit of 120,000. That gave me a balance of 120,000. And then I just went ahead and did what? Debited it 10,000, didn't I? So there's $110,000 left in the unearned revenue account now. Okay. How many more months of service do I have to give them now? I have to give them 11 more months of service. 110,000 divided by the 11 months I have left still comes out to the 10,000 a month that I'm going to be providing, right? That was 1 month. Okay. Okay, good. So you in the back there, when I make the next month's journal entry, August 30th, what should I do? August 31st, whatever. So August 31st has come by now, which, okay, when I have revenue, I credit it, don't I, to increase it? When you have revenue to um, okay, do we have this slide down now? Okay, so if he's earned revenue, I'm not going to debit revenue. I'm going to do what? I'm going to credit revenue to increase the revenue, right? Okay. Okay, good. So I'm going to come back then to this problem, and I'm going to ask the question again. What should I do on August 30th when we have received, when we have earned that next month's revenue? Huh? Credit. Good. I'm going to credit the revenue, 10,000. And I can now reduce that liability by debiting the unearned, can't I? For 10,000? Now the liability is what? 100,000 that's left in there, and that 100,000 that's left now is representing the 10 months of service I have left. 10,000 a month, right? And it'll just keep going like that. Okay? So if it's 10,000 a month, if I know that through my calculation that I had made up here that we're dealing with 10,000 a month, what if I asked you what is the revenue that they should record for the year ending December 31st? How many months is that? Sign the contract on June 30th to provide service in July, August, September, October, November. That's 6 months of service that we were going to provide, right? So in that situation, we would have done what on December 31st? Debited the unearned for how much? Good, 60,000, the 6 months of service. Credit revenue for 60,000, right? Right? 10,000 a month, 6 months. Okay. Okay, good. So the answer to this question is when I provide the service, liabilities, unearned revenue decreases, and revenue got to increase, right? Does that recognize that revenue? Okay. Okay, good. Come over. Froggy purchased a building for $1.2 million, but I did not have the cash to purchase the building, but the seller said they would take $1 million cash down payment and that I could pay the $200,000 balance for the next 2 years. Okay, so what's going to happen here now? Well, am I going to get a building for $1.2 million? Am I getting a building for $1.2 million? So that means that I have to debit building for how much? $1,200,000. Good. I have to credit my cash. I'm giving up the cash as a down payment, right? So I have to credit cash for $1 million. Do I need a debit or a credit to make this journal entry balance? Not a trick question. Do I need a debit or a credit to make this journal entry balance? Not a not a trick question, huh? I need a credit of 200,000 to make this journal entry balance, and that credit is going to be to payable, isn't it? Because I have to pay a bill later. Get it? Pay a bill, a liability. I have to pay the person later. That's a liability, isn't it? Okay. So as a result of the transaction, what happened? Well, is cash an asset? Cash went down $1 million, but building, is that an asset? Went up 200,000, right? So the assets increased 200,000, as did what? As did the liabilities increase. The credit increased 200,000. If I'm telling you assets increased 200,000, I have only two choices. Either my liabilities increased or my stockholders' equity increased, right? This was a liability increasing. Does this transaction sound familiar? This is right off of the little example. I mean, the little, I don't know if we call it the little example. Maybe we should call it the big example. Where are you, example? The in-class example right here, which I showed you a little bit earlier. That was that same transaction right here. If we just want to see how it gets posted through the financial statements now. We had what? We had cash that we bought a building, I should say, for $1.2 million. Where's my building? There's the debit to my building as I post it. I credit the cash, what? Credit the cash $1 million. So my cash went down, but my building came up. So my assets went up 200,000. To keep assets equal liabilities in balance, I needed to do what? Increase either my liabilities or my stockholders' equity. That was a liability because it was a bill, right? I have to pay this person later. Okay, so that was that same exact transaction, and all I did was turn it into a little, fact pattern. All right. Okay, good. How about March 1st, Mudhoney purchased equipment for $30,000. The company's depreciating the equipment at a rate of $500 per month. At January 31st, 2015, accumulated depreciation is, it's $500. I'm just not sure that we're ready for this at this point. Hold off on this. Okay, we're going to look at something in chapter 3, and we'll just hold off. Wait for a second, and I'll explain it to you later. Okay. I'll explain this to you better once we've had more time to look at this. Okay, so we'll get into that. If you understand already, that's fine, but we'll get more into it. Okay. All right. Now we look at this number 12, and we see that we have this Fugazi company, revenues, expenses, and I'm asking you to go ahead and analyze the retained earnings here. So if we're dealing with the retained earnings, and I'm asking you what the ending balance is at the end of the year, I must want you to analyze these transactions here, this information as it's affected retained earnings for the entire year. So I'm going to look at the beginning balance, the adds, the subtracts, the ending balance, right? What's the beginning balance? Beginning balance, they told me, is 50,000. Good. So I'm going to pick up that 50,000. With me so far? Okay. Now I have to figure out the add is typically net income, right? The add is net income. But if you look at this, this person had revenues. This company had revenues of 70. And if you total up all those expenses, starting with that 45,000 and adding through to that 2,000, their expenses are 75,500. Can that happen? Can a company have expenses more than revenues? Let's hope it doesn't happen to you, but it happens to companies, right? So this company has a loss for the period, don't they? So since they have a loss, that's going to be actually a subtract from the retained earnings, right? Oops, I wrote it in the wrong place there because I wanted to put my numbers there. So that's actually not net income, but that is a, what do we call it? When it's negative, that's a loss of 5,500. We're reducing the retained earnings. Remember, retained earnings, the usual balance is a credit, isn't it? And what happens? If my expenses are more than my revenues, then my debits on the income statement are more than my credits on the income statement, aren't they? Right? So that results in a debit balance for my net income of 5,500. And then what? Did they pay any dividends? It'd be kind of weird, in my opinion, to pay a dividend in a year in which you suffered a loss. I mean, people are going to say, hey, that's okay, hang on to the cash. It looks like you're having a little trouble right now. Okay? But in this case, they went ahead and paid a dividend for some weird reason, and we end up with what, 34,500 after we pay out that ridiculous dividend in a year when we had a loss? Yes, sir? Would it be wrong if you did that on your calculator? Would it be wrong if you did it where? In the middle of the street somewhere? I mean, what do you mean? Would it be wrong if you did it? Would it be wrong if you did it where? And again, I ask you, would it be wrong if you did it where? On a financial statement somewhere? Yes, sir. I understand that, but I'm trying to understand, where does he want to do this? On his scratch paper? During the test? Huh? Huh? On the test? Would I mark you wrong if if the answer was B and I ran the Scantron through the machine and it marked it correct? Then it wouldn't be wrong. Okay. I'm not sure where we're thinking we're going to do this. Okay. No, I don't care about the work. If you put it in your, like I say, if you put it in your calculator like that, I'm fine. Okay. The reason I'm asking this question, I know I'm being a little bit of an ass about it, but I'm doing it on purpose because I want you to understand. So I'm not being an ass by accident. It's on purpose that I'm being, okay? Okay, so what I'm talking about is on your statement of retained earnings, okay? This is why I'm asking this. On the statement of retained earnings, we have to present it a certain way. So it would be beginning balance. Beginning balance is 50,000, right? Okay, so we're talking about a presentation of a financial statement, right? Then we'd have to show what? Add net income. Net income, in this case, we'd say subtract loss. On our statement of retained earnings, we'd say what? Subtract, or thank you. I'd say less loss. How much is my loss? 5,500, right? Less dividends. And the dividends are what? 10,000? And then that would give me balance at 12/31, whatever year it is, whatever year this was when we were doing this, 13. The balance would be then the 34,500. Okay, that's the proper presentation on the statement of retained earnings, right? So that this is my income statement that they showed you up here. So remember, we showed how we flow from the income statement to the statement of retained earnings, and then the dividends come out of the statement of retained earnings. They're not reported on the income statement, right? So when you say, would it matter in terms of me checking work on your test and seeing if you did it that way, I don't care. But in terms of matter of presentation for our financial statement reporting purposes, this is the way you do it, right? Okay. Okay, good. Come over. Oh, just when we were having fun. Okay? All right, so that's pretty much chapter two's quiz, okay?